Hello guys, it's Toby here. I am the Ecom Business Coach. In this training, I'm going to teach you one of the most important things that you need to get right in your ecom business, and that's your product pricing. Pricing is vital because if you get it wrong and it's too high, it's going to affect your sales. You get it wrong and it's too low, it's going to affect your profit. So it's really important we get that right. In this training, I'll go through the 6 steps that I use with my clients to help them set their pricing. Everything I do is numbers driven. I am an accountant. Please don't hold that against me. But it does mean that everything I do with my clients and with you is numbers driven. Numbers are the language of business. They show you what's working and what's not, and they help you make much better decisions because it gives you objective information that you can then use to make those better decisions. That means I'm going to have to go through a few concepts with you from an accounting and a numbers point of view. So please bear with me, but if you learn this stuff, it's vitally important and will massively help you in your business. Now let's jump into it. I'm going to jump into a few slides for training that I go through with my clients. The first thing here, the first concept is really understanding what your business success drivers are. There's 3 things that we need to focus on as a business owner to be successful. Number 1 is obviously driving sales. Number 2 is then maximizing or turning as much of those sales as we possibly can into profit. And then number 3 is then turning that profit into cash as effectively and quickly as we possibly can. Pricing affects both our sales and our profit. So that's why it's really important we get this right. There's a great term that I use with my clients, and that is something that you should focus on too, which is turnover is vanity, profit is sanity, and cash is king. That means people who just focus on sales and don't focus on the profit are getting it wrong. It's no point us just driving sales or at the detriment of profit. And we've got an example I'm going to go through later on in this training, which will demonstrate that very clearly. But that's why profit is sanity. Profit is sanity because that's what it's all about. Your business is there to make profit. Cash is king because without cash, your business is dead. And you need to develop cash to either reinvest into the business or to help improve and build your wealth. So it's really important we do that. But let's get into the 6 steps. And let's look first and foremost at the first thing you need to do to get your pricing right. And that's collate the cost together of your products. So you should do one of my favorite things, a spreadsheet, which you can do yourself or get your bookkeeper to help me or get me to help you, which kind of lists down all the products that you sell. And it has a column in there for the costs of what those products cost you. Now, if you're buying products from someone else and then selling them on, obviously those costs are what you're paying from your supplier. Remember also to include shipping that you pay a supplier to get it to you as well, because that's a cost for you too. So you need to think about that too. Also, you actually do need to think about shipping to your customers if you're offering, for example, free shipping or cheaper shipping on your site. Because you have to pay for that free shipping or cheaper shipping, that will come from your margins. So if you are doing that, you need to build that in as well. Shipping is obviously has a massive impact on abandoned carts, and it also has a massive impact on us as business owners. It can be 5 to 20% of the product price, depending on usually the weight and size of the products you're sending out. But shipping's a big issue, but we need to bear in mind that if we are subsidizing some of that shipping to help with abandoned carts or to increase sales, we need to build that into the cost of the products as well. Now, the other thing you need to think about as well is if you are manufacturing your own products, you need to make sure you know how much it costs you to manufacture each product. So it obviously includes all the raw materials or ingredients that go into that product, any packaging, and then any labor related to the manufacture of that product. So you need to make sure you've got systems set up to be able to record that. And that's often a big problem that I find with e-com businesses is straight off the bat, they don't really know their costs. They don't know their costs. Often they don't know their numbers, but they don't know their costs, especially when they're manufacturing themselves. I've had a few businesses where I've gone in there and one of the first things we've done is gone, okay, let's work out how much it actually does cost you to produce a product. And then we can work out, okay, whether our pricing is suitable or not. So please bear that in mind and make sure that you collate that together. That's a really important exercise for you to follow. So that's the first thing, and obviously a very important thing. You then want to calculate what your gross profit margin, so GPM is gross profit margins. This is probably one of the first accounting terms that you need to be well and truly across. And that's your gross profit and your gross profit margin, which is basically just a percentage of that. But we want to know at the moment, what's your gross profit margin on each product. So go into the spreadsheet, put your actual costs in there, minus put your actual costs in there, put your current sales price in there, minus those two off one another. That should then give you a profit. We then can divide that by the sales to work out what your percentage is, so you know what margin you're getting for each product right now. Now, this is probably a good point to talk about GST or any sales tax where you are. Whenever you've got a tax like GST or a sales tax, you're just collecting money for the government. It's not your money. It shouldn't be included in any of these calculations we're doing now. So all the figures should be net, because that's your money. And it's a pain in the ass, obviously, when you're selling to the public, because obviously a chunk of that goes to the government. But it is what it is, and what we're playing with is the net amounts. Always use the net amounts. Now let's talk or go a bit deeper into gross profit and what gross profit is. So here on this slide here, we've got a standard profit and loss account on the right hand side. A standard profit and loss account has got sales, which is obviously the sales you've done for that period of time. It's then got your cost of sales, which is what we call your variable costs, the cost related to the product. So the thing we calculated on number one. So that's the cost of you buying the product, of paying the shipping to get it to you, or the cost of you manufacturing the product, including labour, materials, and packaging and stuff like that. That's what goes into cost of sales or your variable cost. What's left then is what we call your gross profit. So gross profit is what's left after you've paid your variable costs from your sales. So you can see on this example here, that's $300,000. On the left, I've got a definition of what gross profit is. So gross profit is the amount of sales remaining after taking your cost of sales or variable costs off. So that's what your gross profit is. This is a really important figure for you to know. And it's also really important to know it as a percentage. Because as a percentage, you want to make sure that it's not changing. So your sales might go up and then your cost of sales go up, but they need to go in line with each other. Or ideally your sales go up and your cost of sales don't go up, so your margins go up. So margin is very important. You can see on this business here, and I think it's actually on the next slide, then we talk about gross profit margins. This is when we turn it into a percentage. So you can see here, gross profit margin, there's the formula for doing for work calculating. So it's gross profit divided by sales times 100 gives you your gross profit margin. So in this example, that's 300,000 divided by 1,000,000 times 100 is 30%. So 30% on this example here is your gross profit margin. 30% is an average gross profit margin for a business. Now, obviously, some businesses are higher, some businesses are lower. But if your margin is higher than 30%, you're in a high margin business. If your margin is lower than 30%, you're in a low margin business. Now, what tends to change that is obviously the strategy people are using, whether they're selling high margin products or not, and also whether they go for a low cost thing, also competition. That usually drives that down as well. But 30% is an average, and that's what your gross profit margin is. And the first thing and the biggest impact you can have on your gross profit margin is your pricing. Because if you can up your pricing and your cost of sales stay the same, your gross profit goes up straight away. So that's where that can be really effective. As an example, I've got a client where just before Christmas, or probably a couple of months ago now, we put their prices up. And we put their prices up by 10% across the board. Now, often when I talk about raising prices, which is part of what you'll end up doing potentially when you set or review the prices you've got on your products you're selling right now, most people go, oh no, everyone's going to go crazy, it's not going to work, people aren't going to like it, and people get very scared. People get very scared and intimidated when raising prices, and I'm not surprised, but nobody cares more about the price than you. You'll be surprised how little some people care about pricing. In this example here, we upped their prices by 10% across the board. We put it on the website. We prepared an email, sent it out to 20,000 people on the email list. Guess how many people came back to us? 0. No one. No one batted an eyelid. And everyone just carried on. The sales weren't affected either. And I've done this for 20 years or so. Yeah, I know, I've been doing it a long time. And I've used that strategy or raised prices many, many times and never had a problem. Now, obviously, you need to be a bit smart. You don't want to do it in the middle of a recession, for example. But it can be done. And what happens is it instantly goes straight onto your gross profit, which then increases your profit, which is obviously the reason we're in business. So then if you look at the next thing on there, you've got your overheads, and then you got your profit in the profit loss account. But here, what we're focused on is gross profit and gross profit margin. But that's what we're talking about. This profit and loss account shows it as a whole. In step 2 here, I want you to calculate it for each product. Because we can then see which one of our products are higher margin and which ones are lower margin, and work out which ones we want to up because they're too low, and which ones are okay where they're at. But let's calculate where they're at now. Third step is then let's have a look at the competition, what they're doing. Now, it's important to know where the market is and what other people are charging, but it's also important not to get into a price war. Price wars are not good for anyone. What will often happen is the big player will win because they have deeper pockets. They'll send everybody else broke, and then they'll come back and up the prices. So don't get sucked into a price war. You can't be selling products low or a cheap price. It's not a good strategy. I'll talk about that in a bit more in a second. But the key thing is here is let's have a look what the competition are charging, because then we can compare the two. Because ultimately, there's two sides to pricing. There's pricing in the fact what we would like to charge based on our costs, and there's pricing of what the market will bear and what the market will pay. And ultimately, that one wins. But if we find out the market's not going to pay what we want, where we can get a healthy margin, then that's when we need to think about looking at reducing our costs and reducing the cost of the product. Next thing on here then is we need to look at your value. So identify the customer value. And this is where you're going, okay, all right, I know now how much it costs me to produce or buy my products. I know what margins I'm making now. I know what competition are charging. All right, how does my product compare to my competitors? What are some of the points of difference or the value in what I'm selling compared to what they've got? And a great way of doing this is look at using this value equation, because people don't buy on price. And I'm sure you're the same too. Price is just one factor, but most people buy on value. If you look at the car you drive, the drinks you drink, the clothes you wear, the equipment you buy, how much is that? Are you buying the cheapest? Is it the cheapest stuff? Could you got a cheaper car? I guarantee you could have. So there's another factor going into when we buy something. A good example of this is if you go to a supermarket and you got 2 boxes of eggs. One box is $3, the other box is $3.30. Now, if they're 2 boxes exactly the same, no difference on the packaging, you're just going to go for the cheaper one. But if the $3.30 one has free range eggs, hand-picked, large, whatever, and a few other benefits, if that's important to you, you'll be willing to pay a little bit more. And that's what you want to do with your products, is identify what are the things in your product that benefit the customer. Because the customers will buy on value, not on price. So they're willing to pay a little bit more if there's more benefits. So the value is the benefits minus the cost is the value that they see in the product. So that's what we need to focus on. We need to up those benefits. Because the other side of this equation is the cost. So you can increase the value by reducing the cost. That's people getting into a price war basically, but often you'll see it. Your competitors won't know how to compete and all they do is they undercut you. But that's a recipe for disaster, because if you copy them and then undercut them, then you are in a price war. And it's the quickest to the bottom. The other problem is there are people who can do that. So they can lead on cost. But these are usually big players with large economies of scale who can go to suppliers and demand cheaper prices. Coles and Woolies come to mind, for example. And they will outprice competitors to try and get rid of them and try and beat them in the market. And they're going for that low cost. We, as small and medium-sized businesses, shouldn't play that game. You're not going to win that game. You're much better off focusing on the benefits part of this equation and getting your benefits across to what you do and why your product's superior. Now, what I've found is that most e-com business owners are not good at doing this. Their marketing sucks, or they're not getting those benefits across quickly and clearly enough. Sometimes I sit down with business owners and we talk through their product, and it sounds amazing. All the things they do, all the things the product does. But then when I look at the packaging or look at the website, none of that's really articulated well. So the customer doesn't know it. And there's another word you can add to this equation in front of each one, is perceived. So it's perceived benefits, not the actual benefits, because most people don't know the benefits or won't take the time to dig deep to find them out. We need to get it across very quickly and clearly so they can see those benefits, and the perception goes up. That's why it's not always the best product that wins out there. It's the one who markets the best, because the perception is that that one's got more good customer value. That's why it's important you focus on that. You look on each product and go, okay, why is it this product category or the business as a whole or this specific product is better value for the customer? What benefits does it give them over my competition? So it's a really powerful tool and a powerful way of you increasing that value so that you can charge more and increase that margin. Because then you can set your pricing for your product. Now, when you're setting pricing, there's a few things you need to think about. And I'm going to give you an example here about discounting and why that's not important. But the key thing is when you're pricing your products, you've obviously got potentially two prices. You've got retail and wholesale, depending what you're doing. But if you're manufacturing your own product, or you've got distribution rights for your product in a country or a region, then potentially you can wholesale. So if you want to wholesale, though, you have to have enough margin in the product for your wholesaler and you to make a profit. So your margins need to be a lot higher. Now, I've talked about your average gross profit margin being around 30%. You want your products being 40% if you're buying from somebody else and selling on in a retail environment. Or if you're doing wholesale, you want it to be 60 to 80%. So you can both share 40 to 30% each. So that's what you need to be thinking about when you're setting those pricing. The other key thing as well, and this is a common perception that business owners have, is they get tempted to lower prices. So obviously I'm badgering on this point about not lowering your prices. And this is an example of why not to do it and how you could end up sacrificing your profit just for turnover. So often people think lower prices equals higher sales equals higher profits. Now in this example here, we've got two options. We've got a business here that's selling 1,000 widgets for $10 each. That's $10,000. They cost $7. That's $7,000 in cost. So the gross profit is $3,000, 30% margin. Their overheads are $2,500. So at the moment they're making $500. Now they've got two options their team can take from a pricing point of view. They can increase their sales volume by 20% if they reduce their prices by $10 to $9. Or they could put up their prices by 10% to $11, but that would lose 20% of their sales volume. So which option would you take? I'm guessing by my tone of this whole presentation that you probably know that option A doesn't work, but people tend to think it will because they focus on turnover, 20% extra turnover. Remember, turnover is vanity. Profit is sanity, and that's where we need to stick. But when we look at option A, you can see here that their revenue, they do 1,200 widgets, but at $9 each, that's 10,800. Their cost of sales is still $7 per widget. And then so their gross profit is 2,400, overheads is the same. They've now lost money. Now they're sending themselves broke. If they carry on doing that, they're gone. They're out of business. So you have to be very careful that reducing prices just by 10% can be very detrimental to your business. So no discounting. But when you've got option B, well, they still actually lose 20% of their customers, but they've increased their prices to $11. Their profit's gone up to 700 from 500. So it's actually gone up. They actually earn more with less customers. Less customers to deal with all the stress of dealing with those customers too. Now, it's not always the case. Your profit could go up if you discount and enough customers come in, then that will overtake it. But in this example, to get option A more profitable option B, sales or customer amount would need to go up by 80%. So it's a massive increase. And this is why most businesses our sizes just can't play in that field. That's for the big boys. That's why we need to focus on adding the value and increasing the margin rather than competing on price. I think I've done that point to death now. Hopefully you get it. The last point then is to calculate the gross profit margin, the new gross profit margin on each product, and see where it sits. And see if you're happy with that. See if we got the average margin as a whole up for the business, and see where potentially we still need to make improvements. And that kind of gives you a bit of a framework to follow when you're setting your prices. And they're kind of the 6 steps I work with my clients to do that. Now, if you'd like some help with this, then by all means give me a shout. If you've got any questions, by all means add your comments down below and I'll check them out. And please subscribe to the channel if you'd like some more training on how to improve your e-com store. Look forward to talking to you again, guys, soon. See ya. Bye.